Welcome to the Yukon Project's live talk session. Today, we're going to be talking about personal loans, which there's a lot of debate about personal loans right now.
It's a
We're going to
huge
get into,
topic too. It's big.
yeah, yeah, well, big number of people, number of dollars, impact to your financial future. A lot of people have opinions. We're going to touch on facts, and we're going to stay on facts. So, we're going to talk about when to use one and when not to. So with that, take it away.
Well, and hey, before we even get going too far, let's make sure that we're very clear about how big this is, right? If you've never had a personal loan before, or if you don't know someone who hasn't used a personal loan before, that's maybe surprising. You might be surprised to learn how many people actually have used a personal loan before, because it is a lot of people. In fact, if you look at the number of people who have had a personal loan before, there's a lot of money out there in personal loans. $232 billion.
So that's a lot of money out there. But when I look at this, what I think is crazy is how fast it's grown in the last 2 years. Can you tell us a little about why that might be? I mean, do you have an opinion? I know I have an idea, but before I throw that out there, why has it gone up so much in the last 10 years?
That is a really interesting question. I think the bigger question that maybe needs to be asked is what's going on with that dip in 2020 and 2021? And I think what happened there was obviously the pandemic. But the reason the pandemic was such a significant thing for personal loans is because all the lenders had no idea what was going to happen. And so they stopped lending to people. So I don't think that was entirely because there was a lack of demand, but there was a lack of clarity in the industry. And so if you look at that curve, we're back to where that curve should have been if the pandemic didn't ever happen. So is that growing because of natural population growth? There's some of that. But there's also the reality that I think more and more people are using personal loans today than they ever have before.
Yeah, and I think there's a lot into that. People are using personal loans in lieu of other things that they used to use before. I won't say they're using credit cards less, but they are using it to pay down credit cards. They're using it instead of credit cards in a way. But there's another lending process that's out there, which is home equity loans, that's really collapsing, or has in the last 10 years. And I think people are finding that it's easier to get a personal loan than do a home equity loan. And so you see that money actually moving places, even though home equity loans or home equity lines of credit often have lower rates than a personal loan.
So this is a lot of money out there, but let's talk about how many people actually have personal loans. 22.4 million Americans currently have a personal loan. To put that into perspective, it's a little less than 9% of the population, which means that if you went out and grabbed 11 people, just randomly, one of them will currently have a personal loan.
That's a lot. Now, that's not nearly as much as, say, credit cards, which is what, about 75 or 80% of people. But still, for something that's grown so fast in the last 10 years, that's definitely a lot of people that's changed over the short time.
So here's a mind-blowing statistic that shows kind of the dichotomy of what's going on in the country right now. This is almost exactly the same number of millionaires in the United States right now.
Now that is an interesting statistic. I would not have believed that 1 in 11 people was also a millionaire.
So on one side of the bag, on one side of the curve, you've got 22 million people who take out a personal loan. On the other side, you've got 22 million millionaires in the country right now. Now, most of us may be in the middle, but sometimes you might need a personal loan.
I'm going to throw you a curveball. I think part of the growth is driven by the fact that more people are aware that personal loans exist, and also they're using this more and more to consolidate their debt as they let credit card debts get away from them.
Yeah,
No question, no question, debt consolidation is a big issue. What is really interesting, and this is not probably the time or place to get into it, but the whole idea of personal loans, payday loans, alternative lending really started to explode in the 1990s. And this is a generational trend in terms of financial services. And it's been growing much more significantly in the last little bit. And it may be partly because, it's harder for average Americans to get by. Unexpected expenses and emergencies pop up that disrupt them in a way that they didn't, their parents' generation didn't disrupt them. And I think there's some of that as well.
I think it's interesting you mentioned, payday loans and alternative loans and things of that nature. And it's interesting because we said 22.4 million people have personal loans, but not this is based on credit bureau data. And so it doesn't count any of the loans that aren't reported to the credit bureau, which is pretty much every payday loan. Also, pawn loans, they're not going to be reported. So there's probably another couple of million minimum out there who aren't even reported.
Yeah, payday loans are a really interesting one because they're such a short-term loan. Our studies in the past suggested about 6% of the population have had a payday loan in the last 365 days. So it's probably only 2 or 3% that have one right now, but over the course of a year, it's probably 6%, and this is 8% have personal loans. So you start to understand a little bit of the breadth and scope of lending and borrowing in the country.
All right. Well, let's move on from the count. That how big are these personal loans? I mean, I know they can be small, $1,000, $2,000, but they can also be $100,000. SoFi offers loans, for example, $100,000 for personal loans.
Which is probably exactly why this average is not terribly meaningful to people, because the number of people that have $11,000, an $11,000 personal loan is probably not that much, right? To your point, there's a bunch of people with $2,000 to $5,000 loans. And then there are people that skew on the far other side that have, $100,000 loans.
Yeah, this is definitely a left skewed distribution. So the majority of people are going to be far less than $10,000, but those really large numbers really make this average really a lot larger than it is. And the other thing about this is that's the loan balance. That's not the loan amount that they started with. So some of these people have been paying on their loans for 2, 3, 4, 5 years. So it's much smaller than it originally was.
I think that's a really insightful point, which is, the average loan is not at all about, this. This is what is the average current balance.
Right. All right. So we've talked about 22 million people have personal loans. We've talked about the average outstanding balance is $11,000. But really, that's not a useful number because it could be a $2,000 loan or it could be a $100,000 loan. But let's jump into something more important. Let's talk about why people take personal loans out. I mean, is it only one reason? Is it a bunch of reasons? Are there bad reasons? Are there good reasons? What do we got?
Well, I just want to bring up one point, and whether this is true or not, the average household in America makes how much?
Oh.
About $58,000. That's the average.
I was going to say I thought it was $60,000.
Well,
a
lot of the statistics are individuals versus households and whatnot.
Right. And so when I started to look at that number, I was like, okay, whatever number you use for the average, whether it's the median or the average or whatever, it's all over the place, right? So then you start to look at it and you go, okay, so they owe, let's just say let's use a round number and say they make 50,000. And then instead of 11,000 in debt, we'll just use a round number and say it's 10,000. So that same household has $10,000 average personal loan debt. And then on top of that, they have an average of $5,000 credit card debt. That's before they start paying for things like food, mortgage, insurance, stuff like that. And so when I started to look at these numbers, I'm like, we've got to find a way to help people get out of this.
Okay, well, Steve, yes, I agree. We've got to help people, but I'm not going to let you make that statistic fallacy there. So you probably knew that might have been coming. I know Jonathan did. He saw that coming, which is you can't look at all these different averages and think you can stack them all together because they are absolutely talking about different populations. And so the people with personal loans aren't the same necessarily as the people with credit cards, and people with personal loans may have a higher or even lower income on average. We don't really know. So I would never put those together just because it's not going to give you a true picture.
So what you're actually saying is it could actually be way worse for some families.
It could be way worse, but
it
could be a little bit better on average. But I would suggest that it's probably, people that are making $50,000 are probably having, $5,000 and $10,000 in debt versus people that are making $300,000 but have $90,000 or $100,000 or $150,000 in debt. And none of those are good situations, and they're all about equally stressed.
Right. I just found a data point that said close to 34% of households have both.
Yeah. Yeah, I don't think that's unusual. I think that, strained households are strained households. And there are a bunch of people out there who have no debt. But I think to your point, the real issue is we need to figure out how to manage without going into debt. So, but let's get back to the question. What do you guys think? I mean, do you think there are primary reasons why people use these loans? I know we have done research on this in the past. We have a pretty good idea of what's driving this. And some of the research we've done in the past isn't just total numbers, but it's actually talking to people and hearing the reasons they do it. And those reasons are really broad.
Oh yeah. The reasons change. And sometimes it's, when I first started doing this and first started talking to people, I got in this really bad habit of saying, man, I would never have taken a loan for that. And then I started talking to a few more people and I'm like, you know what? That's not really a good thing for me to judge and say you should or shouldn't take the loan for that reason, because you don't know how important something is. And, money's not everything, right? There's things that are life that are just worth whatever the cost may be. And so one thing I learned before we even dig into why you use a reason is you've got to make sure when you're choosing a loan, those reasons need to be meaningful to you, but no one outside you can judge whether it was a good or bad reason, I think, to take a loan.
And we'll get into a little bit later a criteria that you might be able to use to make that judgment on yourself. But yeah, I mean, to your point, there are a lot of reasons, right? And we've listed some of them here, but we've heard a lot of reasons even beyond these. And I think one of the most common is debt consolidation, right? If you've got a lot of credit card debt and you're trying to get on top of it, one of the most effective ways to do that is to find a personal loan that has a significantly lower interest rate than your credit card debt so that you can consolidate it, get it down, one simple payment, and pay it off.
Yeah. And the statistics I've read says about half of all loans are debt consolidation. So that's a really common reason, but then everything else makes up that other half. And there's a lot of really good reasons and processes. And some are surprising. If you say vehicle purchase, well, why didn't you get an auto loan? Well, maybe the car was too old to get an auto loan, or maybe it wasn't. Maybe it was a vehicle, but maybe it was a boat purchase, which you can't get a regular auto loan for. So there's a lot of different reasons why it might still be used for a vehicle purchase, even if it's not. So yeah, there's tons and tons of reasons to get a personal loan.
And debt consolidation is a really interesting one to me because we've done videos on that. You can check them. I'll try to remember to put a link in the description below later. But one of the most important things to think about for debt consolidation is that it can be a really powerful tool to get out of debt, or it can be a disaster. If all it does is free up your credit cards so that you can continue adding debt to your credit cards, debt consolidation can be a really bad move. And I think that that's true of almost all personal loan borrowing. It can there's a fine line between it was a good idea and it was a terrible idea. And you need to be really honest with yourself when you're considering any kind of a personal loan, whether or not it's going to be constructive in your life. And you got to be really honest and clear-eyed about it.
Yeah. So now that's reasons for borrowing, but why would people want to use what's the kind of the value of a personal loan versus a credit card?
Yeah, let's talk about one of the things that is really important about most personal loans, and that's this idea that you don't need collateral. What does that mean, that you don't need collateral? How would you put that in layman's terms?
Easy. You have something. Collateral is something you have and it's worth a value, and you're going to put it up and say, you can have this if I don't pay you back. That's the easy way. Could be your house, could be your car, could be something you take to the pawn shop, but whatever it is, it's something of value that your lender is going to take away from you if you don't repay that loan.
It's essentially saying that if you don't pay back the loan, I have the legal right to take something of value to cover the cost of the loan. And the reason this is significant is because depending on your state, there are states where a lender can take that object, even if it exceeds the value of your loan, and pocket the extra money. And that's the scary part, right? If you have a loan that has $5,000 that you're defaulting on, but you have a $10,000 car that is collateral on that loan, they can take that car, sell it for $10,000 and pay off your loan and keep the rest. Not all states have that, but some do. So you got to be really aware of that. And that's actually one of the benefits of a personal loan is most personal loans are unsecured, which means they're entirely based on the company's belief that you will pay it back.
Now, that doesn't mean they can't do things like sue you and chase it down.
Absolutely.
But there's also it's also a lot different way of recouping that money from you since it's not a collateral base or it's an unsecured loan, as you said.
Yeah, and what's interesting about that is that the idea of a secured versus an unsecured loan, and this is a good thing that you don't have to put up collateral for a personal loan. The downside to it is that almost certainly you're going to have a higher interest rate on this loan because there's higher risk of the lender losing the principal.
Right. Now, you say higher interest rate, it could be only a couple of percentage points versus or 3 or 4 percentage points. That may be a significant amount if you're borrowing $100,000. But if you're borrowing $3,000, those few percentage points might not make a big difference.
Yeah, the flip side, though, is that if you have damaged credit and you're going for an unsecured loan, it could be significantly more expensive, right? It could be literally 20, 30, 40, 60 percentage points more expensive if you have damaged credit for an unsecured loan.
And we know it could be a lot more than that as well. I mean, some personal loan lenders, there's kind of a cutoff line of 36 above and below. And they, if you have damaged credit, you could be significantly above that line. And there's not a lot that's near that line.
And that's why it's really important that if you have damaged credit and you're considering a personal loan, you are really clear about how important it is to get that money, because that money may cost significantly more than it would for someone with good or excellent credit.
Right. Yeah. That can really make a huge difference.
Let's talk about fixed interest rate. What does that mean to have a fixed interest rate, and why is it a good idea?
So that one's pretty quick. I don't want to talk too long on this topic. Fixed interest rate means right off the bat, you know what the interest rate's going to be, and it's not going to change over the life of the loan. And that's different from, say, most credit cards, which have the right to change your interest rate and increase it for a number of different reasons. It could be that the federal funds rates go up, could be that you stop paying, could be simply because they want to. And they can increase those rates by a reasonable amount. Plus, those rates are also a little bit higher to begin with. So having that fixed interest rate and knowing exactly what you're going to pay, I think that's really useful.
Yeah, and I think that's one of the things that people really need. If you're going to get out of debt, you need to know exactly what you're in for, and that's an advantage. So related to that, let's talk about what it means to have fixed principal for a personal loan and why that's important.
Yeah, and that goes right back to it's a nice comparison to a credit card or a line of credit. With a personal loan, you borrow that amount of money, it's set right off the top, and you're going to pay that back over time. versus with a line of credit or a credit card, which people are more used to, you can borrow up and down and your payment changes, and that principal that you owe, that debt you have, can go up, it can go down, and it changes over time.
That's super important, because for people who struggle to pay off credit cards, it's nice to have a fixed principal, to know that I can't just go back and dip in a little bit every single time I need more money or want more money. Sometimes, the line between what we need and what we want in terms of money is a fine line. But the nice thing about a fixed principal, unlike a credit card, is you don't have to worry about just like growing that principal balance that you owe, because it's locked in. Now, it can change. Sometimes lenders will come back to you and ask if you want to refinance or borrow more and whatnot. But that's the exception. You don't ever have to accept that, and you can always go with the fixed principal that you have.
Absolutely.
All right. Now, this is where it gets a little bit more interesting. I want to talk a little bit about how personal loans can affect your credit score. And the reason is because it can affect it in a lot of different ways. And so it's really important to understand, when you are considering a personal loan, what that might actually do to your credit score. Because if you're going to make a big purchase like a car or a house, you want to make sure that your credit score is as high as it possibly can, so you can get the best interest rate. So, Nathan, let's get into it. What are some of the ways that a personal loan can affect your credit score?
Absolutely. Let's start with the very first piece, applying for a loan. Well, as soon as you apply for that loan, that's going to be a hard inquiry. Well, it may not be a hard inquiry depending on where you go, so I won't say as soon as. But if you're going to take out the loan, it's going to require a hard inquiry, one, maybe more. Now, a new hard inquiry on your credit report, depending on a couple of different things, it usually only costs you 3, 4, maybe 10 points on your credit score, and you get those points back in a few months. But that initial ding is going to hurt you just a little bit and bring your credit score down. And then there's this more important process, and I think people misconfuse inquiries with the more important credit factor overall, that 10%, which is new credit. And this is where your credit score is actually going to drop pretty quick, which is you've applied. Now, as soon as you take out that loan, you've got a brand new credit account. That new credit account is going to ding you some more. And that can actually be, and usually is, much more significant than the inquiries themselves. That brand new credit, we know nothing about it. So as an underwriter, as a statistician, or as a credit scoring agency, that's risky. That's going to drop your score.
Okay. Let's talk about the next one. How does actually paying off the personal loan potentially impact your credit score?
So this can impact you in a bunch of different ways. First, every time you make a payment, that's a good thing. That gets you a good positive check. If you're making those payments on time, you're going to see those dings you lost at the beginning come right back. And that's a really good process. It's just helping you build. So making those on-time payments is going to help you. On the flip side of that, if you fail to make a payment, miss one, miss two, especially if you miss them early in the life of the loan, it's really going to bring your credit score down. So you definitely don't want to do that. Got to make sure you make those on-time payments.
Yeah. All right. Average age of credit. Now, this is one that's not really well known by a lot of people. First of all, explain what that is and how taking out a personal loan could affect that.
Well, I touched on part of this already. So usually age of credit is different, and it's interesting, but there's age of credit and then there's amount of new credit. And your new personal loan is going to actually impact you in both of those factors. I talked a little bit about that brand new account. It's going to be new credit. It's going to bring your credit score down, but it's also going to bring it down because it's lowering the average age of credit. So say you have two accounts out there that are both 2 years old, and then you come in and you get that personal loan. Now you have one that's brand new. Well, now I'm going to take the total months there, so 24 plus 24, and then a zero now adds in. So instead of being an average of 24, now I'm coming in with an average of 16. That's dropping that average age, and it's going to lower your credit score just a little bit in that instance. So the other side of it is most personal loans 2, 3, 4 years long. So over the life of that loan, you'll see that average age really rise back up. And again, your credit score will go back up over time.
All right, let's talk about credit mix. What is credit mix, and how significant is the, adding a personal loan to that?
So, in my personal opinion, and everything I've studied and researched on these, from all the credit reports I've analyzed and all the data, to me, credit mix is the throwaway factor. I would simply just not even consider it. If you're looking at it for me, I would never make any choice in credit score based on credit mix. So here's what's going to happen. If you only have credit cards and you add a personal loan and you start showing some on-time payments, it's going to improve your credit score a little bit. If you only have personal loans already, or if you only have auto loans already and you don't have a mortgage or anything like that, it's not going to change your credit mix. It's not going to help you at all. But again, credit mix is the factor that I look at to try to get you to move from a 740 or a 760 up into the 800s. And even then, it's not that important. If you want an 850, which is a dumb idea if you ever ask me, you're going to have a credit mix factor. But until you're looking at moving from a really low 8s to mid 800s and almost to a perfect score, I ignore credit mix.
All right. I think we'd all kind of agree that, personal loans are an important tool, but not necessarily one you should jump into eagerly, right? Take a personal loan only when you absolutely need one. So the question is, if I run into a personal emergency or problem, what are my alternatives? How do I get out of maybe a personal, financial emergency without taking a personal loan? What are some of the options?
Wow. We listed a bunch of options here. And I think the thing to remember here is that, how big is the emergency is the first thing we're going to ask when we look at the alternatives. How urgent is it? And the other side of it is, how big is the emergency? I mean, if it's a $200 emergency or something like that, it's much different than if it's a $15,000 emergency, right? If you've got water damage in your house and you've got to get a repair, you're not going to be able to use overdraft to fix that. It's just not going to work, right? And depending on your credit and your credit situation, you may or may not be able to use a credit card to fix it. So you're going to have to figure those other processes out. But a lot of places, go ahead. What were you going to say?
Well, I was just going to say that's exactly right. Knowing that a big percentage of personal loans are debt consolidation, there's not very many alternatives to debt consolidation other than just avoid it and try to pay off your loans. But what it does tell you is debt consolidation is an accumulation of debt over time. And you're trying to solve that problem with debt consolidation. And maybe the bigger question is, what can you do about it now, as those little things happen? And if you're a little bit more mindful about taking on the debt as you do it, you have a better chance at avoiding accumulating tens of thousands of dollars worth of debt that you then have to consolidate.
Yeah, and that's a good thing to note. And so that's why I said it's always important to know what's your emergency, how are you dealing with it before you stop to look and say alternatives.
So let's talk about, how do you decide whether to take out a personal loan? Nathan, you said earlier that this is a highly personal situation, right? You really need to think about the context in which you are in, what you can do about it, and really be really rational about it. But there are three main steps that I identified that you really ought to go through in your mind before you actually take the plunge. And I would say the first one is importance. How important is the financial emergency you're in right now? And what I mean by that is, if your car is broken down and it's the only way for you to get to work, and not having that car means that you're going to end up losing your job, it's kind of important for you to figure out how to solve that problem and solve it quickly. If the question is, hey, I wanted to go on this weekend trip with my buddies and I don't have the money right now, again, you have to assess how important that is. And I would never tell someone that people's personal relationships are not worth money, because I don't believe that. I think relationships are always worth more than money. But you have to be honest with yourself about whether this trip is important enough to go into debt.
Yeah. But let me add something to that. If you're not telling your friends your financial situation, because you're afraid of how they'll react, then then you don't have the right friends. So if you want to go on a trip, you have to take a personal loan out to do it. I think there's other conversations that need to take place.
Yeah, and that's probably a good estimate. Says, hey, you should probably talk to your friends first before you do those things. But and I think that's also an extreme example of saying, hey, I'm going to take a trip with my friends before you go. And it's probably not a common one out there. So Steve, you hit on that really well, which is, hey, you need to probably have some honest conversations with your friends and make sure they're the right friends. And then you need to assess the importance of this trip, this process. Is it something you've been planning for years and you just hit a little hurdle and lost some hours and you're going to make it up? Or is this, something systematic of a bigger process?
So yes, I grant you that it's maybe not super common on the friend side, but I can tell you in my conversations with people over the years, what is common is I want to take my family and my children on a trip they will remember forever, and I'm willing to go into debt for it. That is much more common than maybe just going out with the buddies. And again, that's a tough decision because you are talking about, childhood and what they remember and creating memories with parents and whatnot. But it may be that you have to kind of scale back what your vision of a trip is and what your vision of making memories is.
Yeah, absolutely.
All right. Let's talk about the idea of alternatives. Once you've decided how important something is, and you've decided it is important and urgent enough that you have to solve the problem, now you really have to be honest about the alternatives that you have at your fingertips. I met somebody once and I talked to the person who said they needed a personal loan of about $2,000 or $3,000, and they went out and got the personal loan, even though they had $3,000 in their savings account, because they didn't want to give up on their savings account. Again, I would never tell someone something is a bad idea, because for them, that savings account represented more than just money. But that was an alternative that she didn't fully consider when you think about the extra costs that incurred in her life to pay the interest and pay over time. And she could have paid herself that interest and ended up with maybe more in that savings account than before, if she had truly assessed the alternatives and what the right decision might have been.
Yeah, absolutely. Alternatives make a huge difference. I mean, a personal loan, we know it's going to have a decent interest rate, so it's probably not better than a credit card. But need immediacy is going to be really important. Do I need it tomorrow, or can I wait 2 weeks? Or can I wait 6 months for that family trip or next summer and do it and postpone it so that I can save the money up and pay cash and get a lot lower price for it in terms of interest and fees rather than having to pay for it right now. So alternatives are definitely important. You want to look and see what you could do and what's the best thing for you, for your personal finances, for your family, if that's part of you.
So let's talk about, comparing options. One of the most important things you need to do is to just really assess what that means. And a lot of websites would tell you, hey, just assess the cost of borrowing money. When I say compare options, I think the other thing you need to do is compare the emotional options. You need to really understand the impact. And let me give you a really simple example. There are people out there who could borrow from family and friends. Absolutely. Maybe not a lot of us have family and friends that have money sitting around, but some people do. And that will always be a cheaper option unless you have family and friends who are really going to charge you a lot of money to borrow money from them. But there is another cost, and that cost could be emotional. It could be the cost of changing a relationship that you don't want to change. And those are some of the options that you have to think about when you're talking about what's going to be best for my financial future, what's going to be best for my relationships, what's going to be best for me, and what's going to give me less stress and cost me less?
Yeah, those options and the factors that go into it. I feel a little bit like some of that you're talking about there is actually goes into the importance as well of how important is this when I go to look at those options, because I've got to make sure that I can't use that or don't want to use that before I go through that process. And then it could be options. Do you take the lower price route? Do you take the higher price route? What's the value of those processes? And then we can go into the very specific of compare options on your personal loans too. Do you get were you able to get a personal loan with lender A or lender B? One charges an upfront fee and a lower interest rate versus one who charges a high interest rate and no upfront fee. And there's values to both of those depending on how you pay them back.
I think, maybe the fourth one for me is, which we don't talk about enough, is what is your backup plan? So I think for me, as I hear you guys talk about this, financial education, financial awareness, financial planning, whatever you want to call it, what happens when the ground shifts? What is your backup plan? What types of jobs, where can I get money? And if you're, and I know this might not be a fun conversation for the majority of the population, but if you wait until when you absolutely need it, you are limited by where you currently are at. And I feel like for me, I hope what the Yukon Project does for people is it starts to change the conversation in their mindset. And so that they don't assume, but they actually start to plan appropriately for what they need to accomplish. And all of us, as we get older, start to realize there's a lot more bumps, twists, and turns than any of us would have ever liked to admit when we're younger.
I think that's true.
Yeah, absolutely. Those are definitely good points.
Yeah, and that idea of planning ahead, I think, is a really important one, especially when it comes to when you take out a personal loan. Because the day you take out that personal loan, you need a plan for how to pay it off early. Not just pay it off, because it's easy for people to look at it and say, I can fit that monthly payment into my schedule, into my budget. But the real question is, what would it take for me to pay this off early? What should I do next week, next month, and 3 months from now in order to do that? And if you start making that plan early, it's easier to do it. If you wait and you say, I'll worry about that later, I've got to deal with this issue right now, you almost certainly won't. In fact, behavioral psychologists have shown that over and over again. If you don't have a plan before, you're not going to have a plan during.
Yeah, so the way I look at it is, do you put windshield wipers on your car when it starts to rain?
Only when it's raining do I go out and buy the windshield wipers.
Exactly. No, we don't. And so, but we treat our finances that way. It's like, when it's raining, I'm now going to start to pay attention. And I want to help people stop that bad behavior.
And sometimes it's just a matter of planning, just knowing that that's what you should do.
Yeah, I don't think personal loans are a bad thing, but they can put you in a bad situation.
Absolutely.
If you don't plan really. There are so many benefits, which you guys touched on. You take a personal loan out, it reduces your credit card debt. It actually, the personal loan will pay off your credit card debt, right? So there are those options, which we're going to get into some of those providers. They pay it off. Your actual credit score goes up because you have a lower interest debt payment and your total available debt amount is higher. And so you actually can see paying off your credit card debt can raise your credit score by quite a bit, which then can put you in a better situation. I mean, I just want to make sure that I know people are doing what they can. I know people are trying their best, and you want people to have the life they want. I just want people to understand the decisions they make and how they make them and when they make them can have implications beyond that. And again, they're not fun conversations. And it'd be much better to talk about which ice cream shop we're going to buy ice cream than, hey, what are we going to do if we need a personal loan? But I hope we can start to have those conversations and it not have the same feeling of failure or I'm not a good person, because that's not what this is. This is not you're a bad person. We're actually trying to make sure that you have what is needed for your life to succeed when there are no safety nets to pick you up.
That's right. All right, so let's talk about, let's say you've gone through the checklist, you know that you want a personal loan. Where do you actually go to find personal loans? And let's start out with just some of the options. If you have good credit, some of these brands are great ones to look for in order to secure a loan. And one of the things that's really important when you're looking for a loan, don't just apply for one loan. Don't apply for a loan and take the first one that is given to you. Apply for 2 or 3 loans, because that's the only way you know whether you're getting the best interest rate and best terms that your situation should allow.
And just remember, your credit score is not impacted till you take the loan. They're all soft credit pulls.
Well, now I won't say they're all, because some banks and some credit unions only do hard pulls. They haven't quite caught up to the soft inquiry credit checks yet. So that's something you should always ask, though, or something at least you take a look at. When you use online tools like ours or any of the other ones, they're going to start with a soft inquiry and see how that won't impact your credit score at all until you move through the final application process and try to take the loan.
Total shameless plug. If you go to the Yukon Project website, you can go and apply and see if any of these lenders will approve you. And that's the important thing, all on a soft credit pull. And that's one of the things that we want to be able to provide people, is the ability to see more than one option all at once, so you don't have to go to every single one of these websites and put in your information and wait.
Yeah, you can do that. I mean, it's obviously an option. Or you can do it all at once with us. And it's more than just these lenders as well. There's about 30 or 40 lenders on our platform that are going to take a look, and everyone that wants to give you a loan is going to come back. So you might get 5, 6, 8, 10 offers out there from different lenders that you can see and compare rates and programs.
Now on the screen, it says for people with good credit. Is there not options for people that have bad credit?
Yes, there are. So here are a handful of lenders for bad or poor credit. Now, I will say, if you've got good credit, you can also go to a bank. You can also go to a credit union. Banks and credit unions provide personal loans. Banks and credit unions don't often offer personal loans anymore. They are struggling to do that. And that's why we didn't include them on the list. But you can go and see. If you've got bad or poor credit, there is a constellation of different companies that want to give you money. And these are often regulated at the state level. And so your particular state may have a very unique set of brands about who will lend money. And if you've got bad or poor credit, you got to be extra cautious about taking a loan, because it will be significantly more expensive for you.
Yeah. And I'm going to add a little bit there on what you said about the banks or credit unions. They are more restrictive than they used to, but I have found from some different conversations, credit unions seem to be much more receptive of bad or poor credit, or at least they believe they are, as I've talked to them now. When I've actually looked at their documentation stuff, it doesn't tend to always play out. But I always tend to think that that's a good phone call to make. At least call your bank or credit union, or go online and just see if they have anything available, especially if you have bad or poor credit. They may have some special programs. And then if we go back up to the alternatives, it also depends on how much money you're trying to borrow. If you're trying to borrow $200, $500, or $15,000, the options are going to be a little bit different at your credit union. So make sure you know that factor first.
Absolutely. You know, as we're starting to wrap up this conversation, I think one of the things that we want to leave you with is, if you can avoid additional debt, you should always do that. Debt is one of those things that will hang over you. It will keep you up at night. It will be this constant drone in the back of your head. And if you can avoid it, it's often better to do that because it will allow you to be a little bit more flexible in your life and to accomplish the things you want to do. If you can't avoid it, make a plan, make sure that you're going into additional debt full with your eyes wide open and you're making the best decision, not just for your current situation. It's often easy to make a decision on your current situation, but have the discipline to make the decision on your future situation. Have a little bit of charity for the future you who will have to make these payments.
Yep.
All right. Any last thoughts, guys, before we sign off?
I think we've done a pretty good job here today. I will add one more on that: avoid additional debt. That is especially important when you do debt consolidation. If you pay off those credit card balances and put them on a loan to save money, don't go out there and start swiping that card again. Give yourself a chance to pay that debt off. That way you're not going farther in debt, but actually taking advantage of the value of the debt consolidation loan.
My last thought for you is, if you are one of those people who are currently in a financial bind and are struggling, give yourself a little charity. Things happen, difficulties come up, work through it, keep your head up. This is not a bad, it doesn't make you a bad person, but you can do this. And that's one of the things that I think you need to hear, is that sometimes things come up and life happens, but you can overcome it. Thanks, everybody.